Michael Saylor seems to be making a lot of people uncomfortable lately. MicroStrategy just scooped up a staggering amount of Bitcoin, funded it by issuing a ton of new stock, and Saylor himself was, well, almost combative defending the whole thing. On the surface, it looks kind of messy, but for the next few minutes, we're going to peel back the layers and show you the surprisingly deliberate and kind of brilliant strategy that's really at play here.
So let's just dive right in. The headlines were all screaming about the big Bitcoin buy. But the real story, the thing that has investors scratching their heads, is how they paid for it all. And on top of that, you have Saylor's completely unapologetic defense of a strategy that, honestly, seems to hurt his own shareholders in the short term. This isn't just about stacking more Bitcoin anymore. This is about rewriting the entire playbook for how MicroStrategy works. It all starts with this number right here, $1.25 billion. That's how much more Bitcoin MicroStrategy just added to its treasure chest. But let's forget the what for a second. The truly fascinating part, the real key to understanding what Saylor's up to, is the how. I mean, where did they get that much cash that fast?
And that brings us to the really uncomfortable part of this strategy. Because this wasn't just a case of, oh no, we need some cash, let's sell some stock. No. This was a carefully orchestrated two-front fundraising attack, and it was designed to prove a very specific point to Wall Street. Okay, so look at how they did this. It's a 1-2 punch. On one hand, you have the brute force method, just selling over $1 billion of their common stock, MSTR, right into the open market. But at the exact same time, they fired up their newer, more specialized tool, raising over $100 million from their preferred stock, STRC. Using both at once? That wasn't a coincidence. It was the first real-world test of their brand new cash-generating engine. And this is where things get really clever. You gotta pay close attention to that preferred stock, the STRC. See, a placement is basically a one-time deal. You sell something and you just hope for the best. But a product, as you see here, is something people come back for again and again. Last week, STRC proved people wanted it. And this week, they came back for more. This is Saylor proving he hasn't just found a piggy bank he can raid. He's built a factory that can basically print cash on demand. So they've built this incredible funding machine. But why? Why do all this? This is where we get to the absolute core of it. Because this isn't just about money. It's about a radical, fundamental shift in what Michael Saylor believes is the most important job of his company. And here it is. This is the pivot. The old MicroStrategy really only had one main goal: protect its stock price premium. All that means is they wanted to make sure the company's market value stayed way higher than the value of the Bitcoin it was holding. And to do that, they were super careful about issuing new stock. But the new MicroStrategy, they're throwing all that caution right out the window. The new goal is simple: grow the Bitcoin pile as big as humanly possible, as fast as possible, even if it makes the stock look less shiny for a little while. It is all about scale over comfort. So if the big goal is to build this impenetrable fortress of Bitcoin, what does that make the common stock, MSTR? Well, think of it as the foundation. It's the steel beams and the concrete. And you don't worry about making a foundation look pretty, you worry about making it strong. That's exactly what's happening now. They are pouring a massive, messy foundation. And yeah, for the people who already own shares, that's uncomfortable. It's noisy, it feels like your ownership is getting watered down. But Saylor's betting you just can't build a skyscraper on a weak foundation. Now, you'd think all this stock being dumped on the market would cause a total panic, right? That the stock price would just collapse. Well, here's the wildest part. It didn't. The stock actually ended the day higher. That's the market basically telling us, okay, we're starting to get it. They're not seeing this as chaotic dilution anymore. They're starting to see it as the deliberate construction of that cash machine we talked about. The whole perception is changing. Okay, so if you're a common shareholder in MSTR, you're probably thinking, this is all great for the company's fortress, but what about me? I'm the one who's feeling all this discomfort. And you know what? That's a totally fair question. And Saylor has an answer that he says isn't based on hope. It's based on math. In that same tense interview, he said this. He claims that 90% of the long-term value will flow to the common shareholder. But notice his key words here. This isn't a promise, he says, it's a structural outcome. He's basically saying the machine is built in such a way that it has to happen. So let's take a look at how that machine actually works.
This table really makes it simple. Think of the company's total value as a giant pizza. The preferred stock, STRC, they get the first slice. It's a guaranteed fixed-size slice. That's their dividend. They always get paid first, but their slice never, ever gets bigger. Now, the common stock, MSTR, they get the entire rest of the pizza. They are the residual claimant. So what happens if the Bitcoin base suddenly doubles and the pizza gets twice as big? Well, the STRC holders still just get their one small fixed slice. The MSTR holders, they get all the new extra pizza. Their potential upside is completely uncapped. The theory is incredibly compelling. I mean, it makes a ton of sense. But theory is one thing, and execution is something else entirely. The strategy is now out in the open for everyone to see, and the real test is just beginning. So what should we actually be looking for to see if this whole thing is working? Here's your checklist. First, keep an eye on that preferred stock, STRC. Can it stay stable, right around its $100 price point? If it does, that proves it's a reliable anchor for the entire structure. Second, does demand keep showing up for it? This will tell us if that cash machine is truly repeatable. And finally, the big one, does the common stock, MSTR, start to show real strength? That's going to be the ultimate sign that the market isn't just comfortable with this new strategy, it's actually confident in it. And this really is the core dynamic right now, isn't it? The overall capital structure, the whole machine, is being built to be incredibly strong and resilient. It's designed to work through all kinds of market cycles. But in the short term, right now, it's the common stock that's absorbing all the discomfort, all the tension of building that massive foundation. So the machine is being built right before our very eyes. Michael Saylor is consciously sacrificing the short-term comfort of his shareholders to construct what he believes is an unshakable financial fortress for the digital age. The bet is crystal clear. Build an indestructible base now, and the common stock will reap almost all the rewards later on. The theory is brilliant, but it all hinges on one massive question. In the wild, volatile world of digital assets, can any foundation, no matter how well built, truly be unbreakable? Well, that's what we're all about to find out.